Did you know that a staggering 90% of traders lose money in the stock market? That's right, 9 out of 10 people who try their hand at trading end up in the red. It's a harsh reality, but it's one we need to address head-on. The reason for these losses. Often it's not some complex financial algorithm or insider trading scheme, but simple, avoidable trading mistakes. In this video, we're diving deep into the 5 most common trading mistakes that could be holding you back from consistent profits. We'll dissect each mistake, understand why it's so detrimental, and most importantly, equip you with the tools and strategies to avoid them. Remember, knowledge is power, and in the world of trading, it could be the difference between consistent gains and devastating losses. One of the biggest pitfalls for new traders, and even seasoned ones, is letting emotions dictate trading decisions. We've all been there, feeling the rush of excitement or the pang of fear as we watch the markets move. You see a stock skyrocketing and FOMO, the fear of missing out, kicks in. The adrenaline rush can be overwhelming, making you feel like you need to act immediately. You buy at the peak, only to watch it plummet the next day. The regret and frustration can be intense, leaving you questioning your decisions. Or you hold on to a losing trade for too long, hoping against hope that it will magically rebound. This is often driven by the fear of admitting a loss. This, my friends, is emotional trading, and it's a recipe for disaster. Emotional trading clouds your judgment and leads to poor decision-making. When we let fear, greed, or hope drive our decisions, we abandon logic and strategy, 2 crucial elements for successful trading. These emotions can lead us astray, away from our well-thought-out plans. So how do we combat this? First, acknowledge your emotions. It's important to be aware of how you're feeling and how those feelings might be influencing your decisions. Recognize when you're feeling anxious, excited, or fearful about a trade. These emotions are natural, but they shouldn't control your actions. Next, take a step back. Physically removing yourself from the trading environment can help clear your mind and provide a fresh perspective. Don't make any impulsive decisions. Impulsivity is the enemy of rational trading. Instead, revisit your trading plan. Your plan is your roadmap, designed to guide you through the ups and downs of the market. Remember, you created that plan for a reason, to guide you through these emotional moments. It's your anchor in turbulent times. If the trade still makes sense according to your plan, proceed with caution. If not, walk away. It's better to miss an opportunity than to make a costly mistake. Remember, every trade doesn't have to be a winner. Accepting this can relieve a lot of pressure. Sometimes the best trade is no trade at all. Patience is a virtue in trading. By mastering your emotions and sticking to your plan, you'll be well on your way to making rational, calculated decisions that benefit your portfolio in the long run. Consistency and discipline are key to long-term success. Imagine setting off on a cross-country road trip with no map, no GPS, no destination in mind. You'd be driving aimlessly, unsure of where you're going or how to get there. Sounds a little crazy, right? Yet many traders embark on their trading journey without a clear plan. Well, that's essentially what it's like trading without a well-defined strategy. The market can be chaotic and overwhelming without a roadmap. A trading plan is your roadmap to success in the market. It acts as a guide, helping you navigate through the complexities of trading. It outlines your financial goals, risk tolerance, preferred trading style, and the strategies you'll use to identify and capitalize on trading opportunities. These strategies are crucial for making informed decisions and staying on track. Without a plan, you're just shooting in the dark, hoping to hit something. This approach is not only risky, but also unsustainable in the long run. A solid trading plan provides structure, discipline, and a clear sense of direction. It helps you stay organized and focused. It helps you stay focused on your goals, avoid impulsive decisions, and measure your progress along the way. This is essential for long-term success. By tracking your progress, you can celebrate milestones and make necessary adjustments to your plan. So how do you develop a winning trading plan? It starts with understanding your personal financial goals and aspirations. Start by defining your financial goals. What do you want to achieve through trading? Are you looking for short-term gains or long-term growth? Your goals will shape your trading strategy. Next, determine your risk tolerance. How much are you willing to lose on a single trade? Understanding your risk tolerance is crucial for managing your investments. How much are you willing to lose on a single trade? This will help you set realistic expectations and avoid emotional trading. Once you have a clear understanding of your goals and risk appetite, you can start exploring different trading strategies. Research is key here. Do you prefer day trading, swing trading, or value investing? Each strategy has its own set of rules and risk profiles. Each strategy comes with its own set of rules and risk profiles. It's important to find one that aligns with your personality and goals. Research and experiment to find the one that aligns best with your personality and goals. Don't be afraid to test different approaches. Remember, your trading plan is a living document. It should evolve as you gain experience and knowledge. Regular updates are essential. It should evolve as you gain experience and knowledge. Continuously review and refine your plan to adapt to changing market conditions. Overtrading is like that friend who keeps talking even when they have nothing left to say. It's excessive, unproductive, and often leads to regret. Just like in conversations, knowing when to stop is crucial in trading. In trading, overtrading occurs when you make too many trades in a short period, exceeding the limits you set in your trading plan. This can be a result of trying to capitalize on every market movement, which is not always a wise strategy. It's usually driven by greed, FOMO, or the false belief that more trades equal more profits. The fear of missing out can cloud your judgment, making you chase trends that are not part of your strategy. The reality is, overtrading can severely damage your portfolio. It can lead to significant financial losses and erode your capital over time. First, it increases your risk exposure. The more trades you make, the more you expose yourself to potential losses. Every time you enter a trade, you're putting capital at risk. This means that each trade carries its own set of risks and potential for loss. The more you trade, the higher the chances of encountering losses. Frequent trading can lead to higher transaction costs, which can eat into your profits. Second, overtrading can lead to poor decision-making. When you're constantly in and out of trades, it becomes harder to make well-thought-out decisions. When you're constantly glued to the charts, you're more likely to make impulsive, emotional trades based on gut feelings rather than sound analysis. This can lead to a cycle of bad decisions and mounting losses. So, how do you avoid the overtrading trap? The key is to have a solid trading plan and stick to it. Stick to your trading plan. Your plan should be your roadmap, guiding you through the ups and downs of the market. Your plan should outline the maximum number of trades you're comfortable making within a specific time frame. This helps you stay disciplined and avoid the temptation to overtrade. Don't deviate from it, no matter how tempting it seems. Market noise can be distracting, but staying focused on your plan is crucial. Focus on quality over quantity. High-quality trades that align with your strategy are more likely to be profitable. Instead of chasing every little price movement, be patient and wait for high-probability setups that align with your strategy. Patience is a virtue in trading. Remember, it's better to miss out on a few good trades than to make a bunch of bad ones. Missing a trade is not the end of the world. It's part of the process. By exercising discipline and restraint, you can avoid the pitfalls of overtrading and protect your hard-earned capital. In the long run, this approach will lead to more sustainable and consistent profits. Imagine building a magnificent sandcastle, meticulously crafting every detail, only to have a rogue wave come crashing down, wiping it out in seconds. That's what it feels like to lose your trading profits because of poor risk management. Risk management is like the insurance policy for your trades. It's about protecting your capital from unexpected losses and ensuring the longevity of your trading career. One of the most effective risk management tools is the stop-loss order. A stop-loss order is an order you place with your broker to automatically sell a stock when it reaches a certain price below your entry point. It acts as a safety net, limiting your potential losses on a trade. Another crucial aspect of risk management is position sizing. This refers to the amount of capital you allocate to a single trade. A good rule of thumb is to risk only a small percentage of your total trading capital on any given trade, typically between 1 to 2%. By risking a smaller percentage, you're limiting your downside potential and protecting your portfolio from significant drawdowns. Remember, trading is all about managing risk, not avoiding it altogether. By implementing sound risk management techniques, you're not only protecting your profits but also preserving your trading capital for future opportunities. In the world of trading, mistakes are inevitable. Even the most successful traders have made their fair share of blunders. The key is to not let those mistakes define you, but to learn from them and come back stronger. Every losing trade is an opportunity for growth. Don't just brush it off and move on. Instead, take the time to analyze what went wrong. Did you deviate from your trading plan? Did you misinterpret a technical indicator? Were there external factors you didn't consider? By understanding the root cause of your mistakes, you can identify patterns and avoid repeating them in the future. Keep a trading journal. This is a valuable tool for tracking your trades, analyzing your performance, and identifying areas for improvement. Record your entry and exit points, your thought process behind each trade, and the outcome. Over time, you'll start to see patterns emerge, both positive and negative, that can help you refine your trading strategy. Embrace continuous learning. The market is constantly evolving, and so should you. Stay updated on market trends, economic indicators, and new trading strategies. Read books, attend webinars, follow reputable financial news sources, and never stop seeking knowledge. Remember, trading is a journey of continuous learning and improvement. So there you have it, the 5 common trading mistakes that could be holding you back from consistent profits. Remember, trading is a marathon, not a sprint. It takes time, discipline, and a willingness to learn from your mistakes to succeed in the long run. Now, I want to hear from you. Have you made any of these trading mistakes in the past? What strategies have you implemented to avoid them? Share your experiences in the comments below. Let's create a supportive community where we can all learn and grow together. And if you found this video helpful, be sure to give it a thumbs up and subscribe to my channel for more trading tips, strategies, and insights. In my next video, we'll be diving deep into technical analysis, exploring the indicators and chart patterns that can help you identify profitable trading opportunities. Until then, happy trading!